Today, everybody's focused on the next AI stocks like NVIDIA. But here's the problem. AI doesn't just need chips. It needs data movement, massive compute, and enormous amounts of power. And all three of those are starting to hit real bottlenecks. So instead of chasing what everybody sees, today we're going to look at three companies quietly sitting underneath the entire AI boom, and almost no one's talking about them. Think about AI like a stack. First, you have to move the data. Then you got to process the data. And finally, you got to power the entire system. If any of those layers break, the entire system slows down. The entire system. So right now, we're starting to see pressure building across all three. First, we have Sivers Semiconductors. What does Sivers do? High-powered lasers for data center optical interconnects. LiDAR, photonics sensing, and data communications, AI and machine learning. This is the data movement layer. AI models today are massive. We're talking billions to trillions of parameters, GPUs needing to communicate constantly, and data moving at extreme speeds. And traditional copper connections, they're starting to hit limits. That's where photonics comes in. Instead of using electricity to move data, you use light. So Sivers focuses on indium phosphate NP lasers, which are critical for high-speed optical connections. Now here's the key. The industry is facing a real supply constraint. Estimates suggest around 2 million NP units needed annually, but only about 600,000 units of production capacity. So that's a massive gap. And only a handful of companies globally can even produce these components at scale. So let's talk about the financials. Sivers is at $3.59 today. The market cap is roughly $500 million to $700 million in range. Revenue is around $25 to $30 million annually. And recently hitting a positive EBITDA in certain quarters. Now compare that to companies like Lumentum or Light, which has multi-billion-dollar cap. It's an established player in the same optical ecosystem, the same industry, but with very different valuations. So if AI demand keeps pushing the bottleneck, SIVE doesn't just grow, it becomes part of the infrastructure AI depends on. Next is IREN, where they have data centers in Texas, Oklahoma, and in Canada. This is a compute layer because AI needs to run it, and that means data centers.
Liquid-cooled AI data center, designed to support up to 50 megawatts of IT load and rack densities reaching 200 kW per rack. This data center project represents the future of infrastructure for AI, not just for IREN, but for the industry as a whole. Horizon One is more than just a name. It's a vision, a reflection of our forward-looking mindset, our commitment to disciplined execution, and our drive to build smarter, more sustainable, and more powerful operations. At IREN, every substation, every data center, every hardware deployment has taught us something. And Horizon One is the result of that experience. Scaled up, accelerated.
AI data centers today require 100 to 300 megawatts of power. Some future builds are targeting gigawatt scale facilities. That's massive. Now, IREN already has large scale data center infrastructure. They have access to renewable power, and they have the capacity to expand. Historically, they're known for Bitcoin mining, but now they're pivoting into AI and high performance compute. Now let's talk numbers. IREN today is trading at about $46, down about 6% today. Market cap is about $4 to $6 billion, depending on which day it is. The revenue is about 300 million annually, and they're still operating with volatility tied to Bitcoin pricing. And so here's the opportunity. AI compute can generate higher, more stable revenue than crypto mining. But here's the risk. The transition is not fully proven yet. So the entire thesis comes down to one question. Can IREN convert its infrastructure into long-term AI contracts? If yes, that's where the upside comes from. But if not, you're still tied to a very volatile business model with crypto. Next is Hammond Power Solutions. This is the layer almost no one is talking about, Hammond Power Solutions. This is the power infrastructure layer, because here's the reality. AI data centers don't just use electricity, they use massive amounts of it. A single large data center can consume as much power as 50,000 to 100,000 homes. Global data center electricity demand is projected to more than double by 2030. And now that power has to be converted, stabilized, and distributed. And that's where Hammond comes in. They manufacture dry type transformers, reactors, and power quality systems. These are not optional. Without this equipment, you don't run the servers, you don't run the GPUs, and you don't run AI. Now let's talk about the financials. Hammond Power is at the stock price is about $250 today, up 1.6%. Revenue is 600 million annually. Strong growth over the last few years. They have consistent profitability, and they're benefiting from industrial electrification and data center demand. So this is not a hype stock. This is a picks and shovels infrastructure company. But as demand increases, that's where companies like Hammond quietly benefit. So Hammond Power Solutions surged recently after hitting a new 52-week high in April 2026. This momentum is driven by a record order backlog and strategic acquisitions. Sentiment suggests continued growth through next quarter as analysts project the company will successfully convert its massive backlog into revenue using expanded manufacturing capacity in Mexico. The bullish run is record backlog provides strong visibility. The company has reported a massive 122% year-over-year increase in order backlog at the end of 2025, reaching record levels. This surge, primarily driven by custom projects for data centers and digital infrastructure, provides exceptional revenue visibility for 2026 as these orders begin shipping in the first half of the year. But what's the bear? Margin pressures from macro headwinds. Gross margins declined to approximately 30%, the most recent fiscal year, down 32% previously. The compression stems from higher raw material costs, supply chain inflation, and unabsorbed overhead from new factory startups, which may continue to weigh on profitability in the short term until operational efficiencies fully materialize, such as most companies. So let's be clear. I'll take a step back and look at this. SIVE or Sivers moves the data. IREN processes the data at the data centers, and Hammond powers the systems with electricity. And this is the foundation layer of AI. And historically, when a major trend expands, the pressure doesn't stay at the top. It moves down the stack. So let's be clear, none of this is guaranteed. SIVE still needs to scale production and win contracts. IREN still needs to prove the AI pivot, and Hammond is steady but not a high-flying growth story. These are very different types of investments, and each one comes with different risks. Here's the key idea. If AI continues growing at this pace, then the bottlenecks don't disappear, they shift. And when they shift, then the companies solving these problems start to matter more. And sometimes those are the companies no one's watching early. These setups are the type of setups that I look for. They're not obvious, they're not crowded, but connected to something massive. And if you want deeper breakdowns, portfolio updates, or what I'm actually doing in the market, check out the memberships below in the comments, and let me know which layer of AI do you think becomes the next bottleneck. And check out buymeacoffee.com, 20-minute stock hunt, and see you in the next one.